Rick, thank you so much for joining us today.
Always a pleasure. Thank you for having me on.
All right. Now, with the precious metal markets, and we're seeing in the last month or so, or last 2 months really, they're taking a bit of a dive. But you've noted that really, if you look at the longer term, commodities in general over the last 18 months have held up quite nicely. And what's really interesting is that the equities haven't. So what is your perspective on that? You're thinking we might see a catch-up in the equities. Can you expand on that?
Yeah, sure. You made lots of points there, all of them good. In the very recent past, gold and silver have been softer, but only if you denominate them in U.S. dollars. The U.S. dollar has been very strong against all currencies and also against gold and silver recently. So the first thing to say is that people who watch gold and silver and describe it as being soft are seeing it soft in U.S. dollars, but not against other currencies, which have also weakened against the U.S. dollar. The second, and I think more important point that I would make is that over the last 18 months, most commodity prices have been strong. The oil price is an example, the copper price, the zinc price, the nickel price. Most commodity prices have been strong, but the companies that produce those profits, while the strength has been reflected in their income statements and to a lesser degree in their balance sheets, the shares haven't kept up. So if we do not slide into a global recession, that is, if commodity prices don't fall dramatically from here, I think you're going to see a catch-up in the prices of the resource equities to reflect the impact that you're seeing on the income statements and on the balance sheets brought about by higher commodity prices.
Now, you've also talked about how you really see in the industry a lot of mergers and acquisitions coming. Can you expand on that?
I do. A couple reasons for that. In the first instance, the companies are newly able to. Their balance sheets and their income statements are robust enough that they can begin to consider mergers and acquisitions. 2009, 2010, 2011, they were just trying to survive. But that's past. The company's balance sheets are in very good shape. So the ability is there, but the need is there too. A decade of underinvestment and the decade before, a decade of misinvestment, has meant that many companies in the mining business are operating on very long-of-tooth assets with non-existent development pipelines and non-existent exploration pipelines. And it's arguable that the only way that they have to play catch-up on a timely basis would be to acquire other assets. The second reason why I think that this is going to occur sooner rather than later is the preference of capital markets for larger, more liquid entities. When you have a larger shareholder base, a larger capital base, you have more liquidity in your stock, your share price tends to reflect greater scale relative to your peers, which means that your cost of equity capital declines, a real competitive advantage. So I think that you're going to see amalgamation also in a less strategic sense to add liquidity and lower the cost of equity capital for issuers. I think this is going to be an important theme over the next few months. I think it's going to surprise investors. One example would be the I think very full price that South 32 just paid for Arizona mining, and I think that's indicative of things to come.
Now, you mentioned about the dollar and its strength right now, and I'd like to turn to that. You've talked before about the bull market in bonds. Now, with the dollar strengthening, what is your perspective on what will happen to the bond market?
Well, the bond market is still strong. That's part of the U.S. dollar strength. It, frankly, as a credit analyst, mystifies me. But I think, we've talked about that at length on your show before. The real yield in the U.S. Treasury, while it's certainly more attractive than it was a year ago, for me is not particularly attractive. I don't believe in the stated rate of inflation. I believe the actual rate of inflation is higher than the stated rate of inflation. At least the people at the Office of Management and Budget, or whoever it is that construct the CPI, don't shop where I shop. But that notwithstanding, the bond market is extremely strong, and the U.S. dollar is extremely strong. My suggestion to you is that the U.S. dollar strength has as much to do with the weakness of competing currencies and competing economies than it does merely as a consequence of the strength in the U.S. economy, because the U.S. economy, from my own point of view, is somewhat less strong than people give it credit for. I wish that were the case, of course, but
right. And to that point, you've said before that really the U.S. economy doesn't look that strong. The reason it looks strong to anybody is really that it's strong in comparison to other economies that are doing worse.
I think that's a great statement. If you look, as an example, at the structural weakness, the demographic weakness in the Japanese economy, and also the weakness in Japan's balance sheet as a society, or if you look at the opacity of the Chinese balance sheet, the fact that the four big Chinese banks are all state-controlled and have made loans that may be questionable to the big Chinese state-owned enterprises, that becomes problematic. If you look at the Eurozone, while the Eurozone economy is certainly in better shape than it was 10 years ago, there are still problems in the periphery, and of course there's the jolt coming up to Europe from Brexit. I'm not one of these gloom and doom guys. You know, the greatest financial trend in history has always been the ascent of man. But I am reminded of the fact that 4 times in my career, the major equity market indexes have fallen by 30, 35% or more. If you look at those declines over the course of a life like mine, I'm 65 years of age, I've been investing for 40-something years, the declines over decades don't matter. They don't matter. But they matter when they occur and for 2 or 3 years afterwards. So I would encourage your listeners not to be gloomy for the long term, but to be very cautious in the near term.
Definitely. And I know some of the people that I've had on my show recently, I remember one person specifically saying that they're looking for a crisis coming this fall in the U.S. What is your perspective on that?
I'm really a credit analyst rather than a, sort of economist. I will tell you that people in our circle, I sort of joke, sometimes I think we need a self-help group called Apocalypse Anonymous. I joke with myself that I've called 17 of the last 3 declines. If we just stay out of the way, when I say we, I mean ourselves as political beings, America is still a society where a group of 4 or 5 geeks in Sunnyvale can commandeer a garage, and out pops Google. So I'm amazed at the resilience of the United States. I'm also appalled at the depth that we sink, the efforts that we take to unravel the great franchise we have. I mean, the idiocy of a trade war, which makes everybody poorer, would be one example. I guess the second question is, given that so much of the economic recovery that the United States has enjoyed has been a function of artificially low interest rates, will the economy be able to continue even mediocre growth in the face of interest rates that seem set to rise? A different question I have is the increasing polarization in the United States, where any bad behavior on the part of the right is acceptable to the right, and any bad behavior on the left is acceptable to the left. The incredible polarization in the United States has me worried. And the labor force participation rate in the United States, not the jobless rate, which measures the number of people who are actively looking for work that can find work, but rather the fact that a large segment of American society seems to have become incapable or unwilling to have or get a job in this economy. There are a lot of things that make me nervous. At the same time, 65 years on Earth as an American has made me long-term still quite positive.
A lot of people see that China is going to be the next superpower. instead of the United States. What is your perspective on that? It seems like you're pretty optimistic for the long term for the United States.
I'm optimistic for both societies for the long term. The Chinese central government has for 30 years made people slowly more free. And when you make them slowly more free, you make them rapidly more rich. The success of the Chinese diaspora around the world sort of foretold that if you made Chinese people more free at home, they could do tremendous things. The savings rate in China relative to the savings rate in most other parts of the world is prodigious. And the Chinese appetite, in fact, reverence for education has also given them some competitive advantages. At the same time, I continue to marvel at the creativity of American society and even the creativity of the American economy, at least those parts of the American economy that can sidestep the government and can continue to create wealth absent the politicians' desire to constrict it or redistribute it.
As for the short term, like for investing, do you believe the U.S. economy is something that we should be investing in? Or it seems like you would say more commodity stocks like precious metal stocks, and you've also talked about other commodities on this show.
I really think you need to do both. If you look at the declines that have occurred in my lifetime, well, Warren Buffett, as an example, has pointed out that 4 times in his career at Berkshire Hathaway, the share price in the 18-month time frame has fallen by half. If you look at a 40-year chart of Berkshire Hathaway, those 50% declines didn't matter. They weren't even hiccups in the long-term chart. So should someone own the broad U.S. economy? Yes, probably with less concentration than they should have owned it after the last time it sold off. But should they? Yes. Should people participate in commodity stocks and precious metal stocks? Yes, they should do that too. One of the difficulties that we have in the gold and natural resource narrative is that when people buy it, sometimes they buy it based on the narrative rather than the reality, and they overinvest relative to their means and resources, which means that even a brief setback in resources shakes their faith and rattles their bank account. So sort of all things, all things in their place. What's lovely about commodity stocks is that they are broadly predictable. I've found that people who try to predict them in 3-month chunks generally end up broke. And a subset of commodity stocks, that is precious metal stocks, what's wonderful about them is that they're probably the most volatile asset class in the world. And what that means is that a fairly small portfolio allocation to precious metals about once in a decade gives you truly spectacular returns. So be in the sector. Just don't be in the sector to the extent that it causes you trauma and where you can't afford either financially or psychologically the sort of setbacks that come periodically in volatile asset classes.
All right. Well, Rick Rule, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yes, absolutely. My thought, first of all, is best wishes to everyone. Beyond that, I always like communicating with your listeners, and in order to give them an incentive to do that, any of your listeners that email me their natural resource portfolio, importantly, email it to me with the names and symbols of the company in their text. If you email that to me at rrule, that's RRULE at sprottglobal.com, I will, on a no-obligation basis, email you back my rankings of the natural resource stocks in your portfolio. I will not rank the non-natural resource stocks in your portfolio because I don't feel qualified to do it. But I will happily, on a no-obligation basis, reply to emails with the names and symbols in text, rank